in coming quarters. So what we'll see is growth being slowed down, and I think it's already being played out in some of the categories like consumer durables, etc. So I think over 6 months, markets are going to be range bound. 6 to 9 months later, as we get comfort from RBI that they're done with the rate hikes and probably inflation is under control and they're looking towards interest rate cuts, that's where we'll see the meaningful kind of an upside for the markets. And I think same is the course for the global markets also. That look range bound till March or probably April, etc. And after that is going to be, we'll see signs of inflation coming under control and market will start globally also discounting some bit of rate cuts towards the end of 23.
Rahul, why are markets not reacting to this straight line decline in crude? Even though most of the assumptions at the by the central banker or by the government is they are centered around the fact that oil will be above $100. Now oil is way below $100. Yet we've not seen any kind of a real excitement in the markets.
Because somewhere markets are now focused on the growth slowdown. See, there is the reason why crude is slowing. And the reason is economies are slowing down. You look at the export data which is coming, whether it's countries in Asia like China, Korea, Vietnam, etc., even for India. So there is a bit of a weakness which is coming. And we know that this has a transmission effect that look, if exports are weak, somewhere commercial real estate, which has been doing well, is going to be slow. Wage growth for the IT sector is going to be slow. So it has this feedback loop for the domestic economy also. And I think that's where market is worried, which is why, to your point, that initially market got euphoric about crude coming down, but now market's more worried about the broad-based global slowdown, which is coming because of higher rates.
How realistic do you think are the bullish assumptions for the Indian banking sector? Just about everybody now is excited about banks like they were about IT a year ago. Those who got over carried away with the IT digitalization theme, they've suffered in 2023. Could the banking bulls see a similar fate in 2023?
Okay. So banking, what could have gone wrong for the sector was if we had a massive drawdown in forex reserves, and that would have forced RBI to come and slam the brakes hard, take the rates even higher. I think as we talk, economy slowed, and that's coming out in trade deficit numbers improving. That's coming out in forex reserves moving from 525 bill to 550 bill. So the macro risks are somewhat reduced for the banking sector. Crude going into winters is not 110 but 85, 90, etc. So those kind of macro risks are reduced. If you look at the banking sector, look, we've not really seen any large surge in credit for the corporates for the sector in last 5-7 years. So there are no concerns about an asset quality. What can impact the sector is if we have huge consumer delinquencies, but we've not seen any job cuts. So next year, what can happen is the sector goes through a period of time correction because investors would start fearing some bit of a rise in delinquencies or normalization of all these asset quality issues. But it's not going to be a meaningful thing. I think there is a broader slowdown which would impact the sector also. The sector did its bit by outperforming massively. I think next year the outperformance is going to be more moderate.
Rahul, why are you worried about the slowdown? Is it going to be more because if the big daddy US heads into a recession, we also are not going to be spared? Because as of yesterday, the RBI has eased off, to be fair, their rate hike quantum at least. And even when it comes to the growth estimate revision, it's only down about 0.2% from the previous 7 to now 6.8.
So I think what happens is markets always trade the second derivative, and which is the pace of change. The pace of change is clearly slowing down. So if you look at the surplus liquidity, if I'm not mistaken, in the July to September quarter, that was running at around 5 to 6 lakhs crores. That's almost gone. So there is a tightness, there is a slowdown coming. And what market is more worried about is where would the growth rates settle at? So markets don't like uncertainty, and I think that's where you will see the multiple derating happen. And that is what I was alluding to the slowdown, that market doesn't know where the economy would settle. And look, a lot of these numbers which we see are lag indicators. So they're right in a direction. But look, when a slowdown is happening, nobody knows whether 6.5 is a correct number or 6 is a correct number. And I think that's what the market starts discounting a bit early.
So, for an Indian investor and a long term one at that, Rahul, where is it that you're going to be safer considering you don't know how the world is going to shape up even in the next 2 months? There are too many moving parts right now.
So I think again, assuming that one has a reasonable allocation to fixed income, which is lucrative, from a longer term, of course, over next 6 months, equity will give you opportunities because let's say 6 months from now, March, etc., equities won't have done anything for 12, 15 months. So that's a time correction which has happened. Globally, we expect it to be a shallow downturn. See, we've not seen the excesses of the previous cycle, which was 2003 to 2007 cycle. So here, even if rates go into a restrictive territory, you see some bit of a slowdown in US. It's going to be a moderate 2-3 quarter slowdown, and as market gets the comfort that look, central banks are moving towards easing late 23 or early 24, markets will start discounting that. And to be fair, positioning also globally is light. And what happens is with China doing well, what may happen is we may get more flows into EMs, funds, etc., which kind of benefits India also. So I'm not too negative from a 1 year plus horizon, but I think the returns would be more back-ended in this 1 year horizon.
Rahul, morning. What about the kind of volatility that we've seen in crude oil prices now hovering around $78 a barrel? That does bode well for us, and not just for the markets, but individual crude derivatives sectors as well.
So absolutely, I think that's where it's coming out in terms of the crude derivatives. You said whether it's paints, alcohol, some of the chemicals, and we'll see generally corporate India benefit. So there's been a big margin squeeze which has happened over last 2 years. I think we'll see the benefits kind of come through as some of these raw material supply bottlenecks ease, some of the raw material pricing kind of eases. So we'll see volume growth slow down a bit, but margin benefits come back. And I think that should be something which would give stability to the market. So our view is markets are going to be range bound. Look, from a global context, 6.5 is not a bad number. Very few economies or very few large economies are growing at these rates for a sustained period of time. So that gives a support for a downside. From an earnings perspective, this tailwind which will come because of crude derivatives correcting would be a tailwind for the corporate India's margin.
Uh, let's divide the market in two parts, Rahul, where growth is visible, but valuations are pricing in FY24, FY25, even FY26, which means those stocks are great companies. Those companies are great, but stocks will not give double-digit returns from here. What is that category?
So that would be again the consumption part of the category. See, it's a multi-year story, but look, what has happened is obviously export slowdown is one part of the angle, but overall inflation has caused a squeeze on consumer wallet. So the consumer is going to be consuming less, obviously, and you will see some bit of a slowdown kind of come through that. But after a period of down trading, after a period of slow sprints, the consumer is going to bounce back, and you have this penetration story also which plays out. So I think somewhere over 2 years, you will see the consumption sectors also give good returns after going through a period of time correction. So expensive names which have done well over last 5-6 years will go through this period of a time correction where returns would be more back-ended. Whereas if you look at something like financials, I think they would still continue to outperform the market. Autos, where probably we've not seen much demand over last 5-7 years. There's a strong model lineup coming for these companies. There's a shift towards hybrids, EVs coming. There's a huge replacement demand. May continue to benefit.
I really appreciate your time. Glad you could join us. And if you don't meet this year, season's greetings for a wonderful year ahead.
Thank you.
Rakesh Sharma joins us, Executive Director with Bajaj Auto. Let's understand from him